Hi, I'm here today at Petronas gas station with my gang, number 17. Today we talk about Petronas compared with Petron. Yeah. It has 50,000 employees and Petron was launched in 1974. More than that, Petron was the tallest building in Malaysia from 1908 to 2004, the tallest building in worldwide. Petronas has 50,000 employees. And also, Petronas was launched in 1978. 1974. Petronas has Petronas has been owned by government of Malaysia and have 35 of countries ruling by Malaysia.
So hi, I'm Rashid Rashid. So I'm going to talk about Petronas strength and the weakness. So the high current and quick ratio is equals to strong short-term financial health. The second one is strong profitability and net profit margin (ROA, ROE), high asset turnover plus efficient use of resource. So they have low debt to equity ratio and financial stability. And the weakness is inventory turnover decline, which reduce the efficiency of the fuel, slower receivable turnover and delayed collection. Payable turnovers weaken the slower supplier payments. So I'm going to talk about next is Petronas Malaysia. So the weakness is low current and quick ratio liquidity concern. Net profit margin dropped to 0.11% in 2024. ROA and ROE decline is weak returns. Debt to equity ratio near 1.0 to higher debt reliance. The strength is inventory turnover 3 times the strong product movement. Receivable turnover improved 12.91 to 16.15. Payables turnover up to 19.96 efficient credit use. Value add service and loyalty programs, car wash and SIM card. So for the end of summary, Petronas has strong overall financial position and minor concerns of efficiency, and Petronas Malaysia have good efficiency but needs improvement in profitability and liquidity. Each company should address specific weakness to enhance the overall financial health. Thank you.
Hi, for my part, I'll be covering the liquidity ratio for Petronas. As you can see here, the current ratio for Petronas in 2023 was 3.26. Meanwhile, in 2024, it has reduced to 3.18. That means that Petronas maintains a very strong current ratio across both years. A ratio above 3 indicates excellent liquidity, meaning the company can cover its short-term obligations multiple times over. The slight decline in 2024 is not alarming, but suggests a minor dip in working capital strength. Now for the quick ratio, in 2023 it was 3.10, and for 2024 it has reduced to 3.02. This means that a high quick ratio shows Petronas can pay off current liabilities without relying on inventory. Although there's slight decline, the company still has strong liquidity from liquid assets like cash and receivables.
Hey, I'm Nasrin Raj here. So I'm going to talk about Petronas gas station. So Petronas first was established on 1988, 1933. So that it's a Philippines' biggest oil company. It's run around 2,000 gas stations around Malaysia and Philippines. And after 1988, after government acquisitions, it has some biggest petroleum company name in Malaysia and Philippines. So
Hi, I'm going to show you the liquidity ratios of Petron Malaysia. So the current ratio, as you can see, here's the info for 2023 and 2024. Current ratio equals to current asset or current liabilities. So for 2023, it's 1.280, and for 2024, it's 1.240. Interpretation of current ratio. The current ratio is above 1, which means Petron can meet short-term liabilities. However, it's much lower than Petronas, and has declined in 2024, indicating reduced short-term financial health. For the quick ratio, here's some info for 2023 and 2024. Quick ratio equals to current asset minus inventory or current liabilities. So for 2023, it's 0.756 and 2024 it's 0.603. Interpretation of quick ratio, both values are below 1, and the drop in 2024 highlights growing reliance on inventory to settle obligations. This may reflect tight cash reserve and weak immediately liquidity. And activity ratios for Petron Malaysia. The first one is asset turnover ratio. Here's the info for 2023 and 2024. Asset turnover ratio equals to revenue average total asset. So for the 2023, it is 3.665, and for 2024, it's 3.403. Interpretation of asset turnover ratio. Extremely high turnover indicates efficient use of asset to generate revenue. However, the drop in 2024 could suggest declining operational efficiency or lower sales volumes. The second one is inventory turnover. As you can see here, some info from 2023 and 2024. All right. Inventory turnover equals to cost of goods sold. For the 2023, 15.873, and for 2024, it's 12.263. Interpretation of inventory turnover drop and show inventory is moving more slowly, which may lead to increased holding costs or reflect overstocking due to demand fluctuation.
This is the continuation of activity ratio for Petron Malaysia. For receivable turnover in 2023, Petron has 12.9%. In 2024, Petron has 16.14%. The interpretation of receivable turnover is a rising ratio indicate faster collection of receivable, improving cash flow and reducing credit risk. For payable turnover in 2023, Petron has 16.4%, and 2024, Petron has 19.95%. The interpretation of payable turnover is a high increase. An increasing turnover shows that Petron is paying its supplier very quickly. This may help secure better supplier terms, but can put pressure on cash reserve. This is a debt ratio for Petron Malaysia. Total debt ratio in 2023, Petron has 0.48%, and in 2024, Petron has 0.949%. The interpretation of total debt ratio is Petron has nearly half its asset financed by debt. The increase in 2024 suggests rising reliance on borrowed funds, which could elevate financial risk. Debt to equity ratio. In 2023, it is 0.94, and in 2024, it is 0.96. The interpretation of debt to equity ratio. A ratio is near one show high dependence on debt. The rising trend further indicates that Petron may be increasing its financial risk and vulnerability to interest rate change. This is the profitability ratio for Petron Malaysia. Net profit margin in 2023, it is 1.58%, and in 2024, it is 0.11%. The interpretation of net profit margin, alarmingly low, that have worsened drastically in 2024. This indicates that Petron is very profitable and face new serious cost or revenue challenges. Return on asset (ROA). In 2023, Petron have 5.79%, and in 2024, it is 0.39%. And the interpretation of return on asset is ROA has collapsed, showing that Petron is unable to efficiently generate profit from its asset. This is a critical operational concern. For ROE, return on equity, in 2023, Petron has 11.24%, and in 2024, it is 0.76%. The interpretation of return on equity (ROE), the ROE have fallen sharply, suggesting that investor returns have nearly disappeared. This raises red flags for shareholder and future investment.
So for the financial performance analysis, I will comparison between Petronas and Petron Malaysia for the year 2023 and 2024. Also look at some key financial ratio and recommendation what both company could improve. Starting with Petronas, we see a slight growth in both liquidity ratio. The current ratio fell from 3.26 to 3.18, and the quick ratio from 3.1 to 3.02, indicating slightly tighter short-term cash flow, likely due to high spending in upstream operation and oil price volatility. But though asset turnover improved a bit. Return on asset dropped significantly from 10.44% to 7.18%, and net profit margin also decreased from 26.4% to 18.06%. This point to higher cost eating into profitability. Also, return on equity fell from 16.05% to 10.87%, showing shareholders are getting less return than before. To address this, Petronas should focus on improving efficiency, especially in downstream operation, and consider using digital tools to control costs better. So for the background ratio, the inventory turnover dropped from 15.87 to 12.26. Both suggest they may be holding too much stock, possibly due to supply chains delay in accurate demand forecasts. We see a turnover increased from 12.91 to 16.15, which actually mean they are taking longer to collect payment. This could affect cash flow at the same time. Payable turnover rose from 16.41 to 19.96, meaning the company is delaying payment to suppliers, helpful for short-term cash flow, but risky for supply relationship. So in summary, Petronas should improve cost control, focus on efficiency in downstream operations, and adopt digital solutions to enhance cash flow management. Secondly, Petron Malaysia need to fix inefficiencies in inventory and receivable, and manage supply payment more carefully to avoid harming partnership. By improving internal processes and using tech-based solution, both companies can strengthen their financial stabilities and resilience in the current world market.